A solid order block trading strategy is often the missing link for many traders who rely on smart money concepts. This is mainly because they don't fully grasp the key criteria that define a high probability order block. In this video, we've clarified and streamlined everything you need to understand so you'll never struggle with order blocks again. To achieve this, we've outlined the ideal order block trading strategy in 6 straightforward steps. But before we proceed, guys, if this is something you're interested in, please hit the like button to support us in creating more videos, and subscribe if you're new. Also, turn on notifications. Catch you right after the intro and disclaimer. So, let's begin with step number 1, which focuses on answering the question, what are order blocks? Here, we have an example of a chart, and the first thing we can quickly observe is that the market is moving within an uptrend. But when we examine this second leg, you might be asking why the price decided to push upward from this exact spot. Looking over to the left side of the chart, we can see a bullish order block. This acted as a support area for price to continue climbing. The reason behind this is that this zone in the market had a clear history of seller participation, which is evident from the significant number of sell orders executed, represented by the bearish candles. This makes it an ideal area for smart money to execute large buy orders, given the absence of notable selling activity in the rest of the leg. To put it simply, bullish order blocks are made up of bearish candles and serve as a support level to drive price higher. On the other hand, we have the bearish order blocks, which are formed from bullish candles. These function in the same way but in reverse, acting instead as resistance on the chart. However, this is just the basic understanding, because the mistake most traders make is failing to recognize the broader market structure required to properly validate an order block. We have a few criteria that make this process straightforward. The first point to note is that there is no fixed number of candles needed to form an order block. For example, on the left, we have an order block composed of 4 candles, while on the right, we have one made from just a single candle. Both are valid order blocks because the number of candles doesn't determine its legitimacy. The only difference the candle count shows is the amount of time sellers were in control. The next detail to cover is something you might have already noticed. When marking order blocks, we focus on the candle bodies, not the wicks. Using this 4-candle example, the order block spans from the opening price of the first candle to the closing price of the last candle. If it's a single candle order block, it would be from that candle's opening price to its closing price. The same principle applies for bearish order blocks. Since a bearish order block is made of bullish candles, the opening price of the first candle is at the bottom, and the closing price of the last candle is at the top. Now that we understand how to mark out an order block, let's move on to the next step, which focuses on how we can confirm if an order block is valid. Using the same chart from earlier, we already know this series of bearish candles formed a bullish order block, which was later respected when price revisited it. But let's imagine we were at the moment when these bearish candles had just completed. The question is, have these bearish candles already created a bullish order block? The answer is no, and the reason is simple. We don't yet know how the market will move next. For example, the price could simply consolidate sideways, meaning those bearish candles would never develop into an order block. The criteria for these candles to qualify as a bullish order block require that we see an impulsive bullish move breaking above the highest top wick of the bearish candles, in this example, the first candle's high. Only once we see this break of structure can we confirm these bearish candles have formed a valid bullish order block. For another example, here we have 4 bearish candles that could potentially become a bullish order block, but this time the highest top wick is on the third candle. This means, to confirm it as valid, price would need to break above the third candle's high. For bearish order blocks, the rule is the same but inverted. We look for a break of the lowest bottom wick among the bullish candles to validate the setup. With that understanding, let's analyze where the next order block appears within this chart structure. First, we see an impulsive bullish move followed by 2 bearish candles. These bearish candles could have formed another bullish order block, but the subsequent bullish move failed to break the previous high before price dropped again. This means no bullish order block was created here. However, when we look at the next bearish candle, we see that this single candle did form a valid order block, as its high was clearly broken during the bullish move that followed. Now, you might ask why we don't include the two earlier bearish candles within the same order block. The reason is that there are two bullish candles between them, creating a gap in bearish momentum. This leads to the final key criterion for defining an order block. If it consists of multiple candles, they must be consecutive, with no opposite colored candles interrupting the sequence. Now that we understand how to correctly identify and validate an order block, the next step is learning how to spot the highest probability order block setups. Starting with our next step, we focus on combining order blocks with fair value gaps. We already know that, for this order block to be valid, price must break structure by pushing above the high of these bearish candles. However, when identifying whether it's a high probability order block, the first clue lies in the bullish move that caused the break of structure. During this impulsive move, we want to see the creation of a bullish fair value gap. The reason is that a fair value gap reflects strong buying pressure, a key factor if we plan to use this area as future support. The specific detail we're interested in is where this fair value gap forms. Ideally, it should develop within the range of the order block, as this means we have two overlapping PD arrays, creating strong bullish confluence in that highlighted zone. Here's another example of a bullish order block where a fair value gap also formed in the subsequent bullish move. The difference in this case is that the gap appeared after price had already moved beyond the order block's range. Because of this, we wouldn't consider it a high probability order block. The absence of overlap means only one PD array is in play, instead of the combined strength of both. In our final example, we see that the impulsive move failed to form any fair value gap at all, indicating weakness in bullish momentum. This also removes it from the category of high probability setups. To summarize, when a fair value gap forms in the move that creates an order block, it builds confluence between PD arrays, strengthening the overall setup. But for this to happen, the fair value gap must overlap with the order block, creating a golden support zone we can target. If the gap forms outside the order block's area, or doesn't form at all, we do not classify it as a high probability order block. Now, let's move on to the next step in identifying high probability order blocks. You should only use order blocks that remain unmitigated. Here's another chart example, and with a quick analysis, we can spot a valid bearish order block overlapping with a bearish fair value gap. This means it meets the criteria for a high probability order block. Advancing the chart forward, we can see it was indeed respected as a resistance area, leading to a rejection as expected. You might think this could serve as a strong resistance zone to target again in the future, but in reality, it's far more likely the price will simply break through it. This is because once an order block has been tested, it becomes mitigated, meaning we should avoid using the same order block more than once. The logic is that smart money targets order blocks due to the high volume of unfilled orders sitting in those zones. When price pushes into an order block, most of those unfilled orders get executed, leaving little to no reason for smart money to re-enter at the same level again. For that reason, we also avoid reusing it. This rule applies even if price only slightly taps into the order block, as, in this case, because it's still considered mitigated and no longer suitable for another setup. A quick tip worth mentioning, when drawing the range of an order block, the 50% midpoint is a level to watch closely. For a bearish order block, the area below the 50% mark often contains the highest concentration of rejection pressure, as this is typically where the majority of orders are positioned. This doesn't mean the setup fails if price enters the upper half, it's simply that the lower half is seen as stronger, especially if a fair value gap is also located there. In the case of bullish order blocks, the concept is reversed, with the upper half being the stronger rejection zone. That said, both halves are still relevant. The midpoint is just a useful guideline when refining setups. So now, moving on to the next step, we have another key piece of criteria for identifying high probability order blocks. Only use order blocks that are formed from a previous PD array. Here's a fresh chart example, and the first thing to notice is that the market has performed a liquidity sweep from the prior swing high. We can confirm this sweep with the change of character that developed during the bearish pullback that followed. If you look closely, this structure has produced a bearish order block along with an overlapping bearish fair value gap. This makes it our first example of a very high probability order block. The reasoning is that after the liquidity sweep, the market structure has already indicated its intended direction. And since the order block emerged as a result of this PD array being respected, it's much more likely to hold, reinforcing the bearish bias within the structure. For another example, here's a chart where the market is in an uptrend. Drawing from our previous lessons on liquidity and fair value gaps, we know that for a bullish trend to keep developing, it must create and find support within bullish fair value gaps, like the one highlighted here. What's interesting is that the move which tapped into and respected this FG also created a bullish order block, confirmed by the break of structure in the next bullish leg. This becomes our second example of a high probability order block because it formed during a move that respected another PD array, in this case, a bullish fair value gap. Going further, as we know, in trending markets the price seeks out fair value gaps to use as support. In this scenario, the order block even contains an overlapping bullish fair value gap, forming a strong support zone that fueled the next upward push. The key takeaway is this: only target order blocks that are generated by another PD array. This could be a liquidity sweep, a fair value gap, or even a separate order block. Doing so not only ensures the order block is aligned with correct order flow, but also reinforces the strength of any overlapping PD array. And this brings us to the next step: only trade order blocks that align with the higher time frame market structure. Here, we have a 15-minute chart, and within this structure, we can spot two valid order blocks, each with its own fair value gap. The challenge, however, is that one is bullish while the other is bearish, meaning the directional biases conflict. It's in scenarios like this that many traders struggle to determine which PD array is more likely to hold. This is exactly why top-down analysis is essential. When we zoom out to the 4-hour chart to examine the broader market structure, we can see that price action is currently unfolding within a classic market maker-sell model. At the top, there's a liquidity sweep, followed by a change of character, signaling a shift in directional bias toward bearishness. Placing the two charts side by side, the movement seen on the 15-minute time frame corresponds to the final candle on the 4-hour chart. With further analysis, we find that this 4-hour candle rejected from a bearish fair value gap located inside a 4-hour bearish order block. So, when deciding which of the two 15-minute order blocks is more likely to be respected, the answer is the bearish order block. This is because it formed during a move that respected the 4-hour bearish fair value gap, placing it in alignment with the higher time frame structure. Moving forward in time confirms this. Price tapped into the bearish order block and then drove sharply lower, completely disregarding the bullish order block. That's it for today. Thank you for watching this video. I hope you gained real value from this video. If you did, be sure to hit that like button. It really helps us out and shows us that you're enjoying the content. And if you're new here, consider subscribing for more trading strategies. Thanks for your time, stay disciplined, stay consistent, and I'll catch you in the next episode.